Hello, this is Raymond Shapiro, Portfolio Manager, the Merchant West SCI Global Equity Feeder Fund, and this is the quarterly report for the period ending 31st March 2024. The fund rose 10.9% in Rand terms, 7.1% in US dollars over the quarter, while its benchmark, the MSCI World Index, gained 12.7% in Rands, 8.9% in US dollars over the period. The MSCI Emerging Markets Index gained 6% in Rands and 2.4% in US dollars over the quarter. The Merchant West SCI Global Equity Feeder Fund invests solely in the US dollar-denominated Merchant West Global Equity Fund. As such, the commentary that follows relates to the underlying Merchant West Global Equity Fund in US dollars, and all returns below are quoted in US dollars. Global markets rallied strongly this quarter, despite the US 10-year bond yield rising from 3.9% at the end of 2023 to 4.2% at the end of March. Markets were buoyed by stronger than expected US growth, which overshadowed interest rates remaining higher for longer than expected. The MSCI World Index was again driven by the technology and financial sectors, although all sectors other than real estate posted positive returns for the quarter. Fund returns were driven by holdings in the technology, communication services, financials, and healthcare sectors. Exposure to consumer staples caused a small drag on returns. A greater relative exposure to consumer staples and underweight to banks, and to a lesser extent energy stocks, were the main drivers of the fund's underperformance compared to its benchmark. The drag on performance from the fund's underweight technology was offset by strong performance technology-oriented holdings in the communication services sector, such as Meta and Alphabet. Major stock-specific contributors to performance over the period included Meta Platforms, Berkshire Hathaway, and Novo Nordisk. Main stock-specific detractors included Nestlé and UK wealth manager St. James Place. While the global narrative for economic growth has shifted from talk of a so-called hard landing to a soft landing to a no landing, recession indicators have not dissipated. These include inverted yield curves, tight credit conditions, and disrupted trade flows. In addition, the world is facing increased uncertainty due to geopolitical tensions, conflicts in Ukraine and the Middle East, and a potential political change across the globe, with more than half the world, including the US and the UK, facing national elections in 2024. On the upside, rate cuts are still expected throughout 2024 and 2025 on the back of forecast cooling inflation. As such, we continue to believe that the most sensible approach is to focus on investing in robust, high-quality businesses with conservative balance sheets. We believe high-quality stocks possessing either structural and/or defensive growth prospects should serve investors well in an uncertain and potentially turbulent 2024. A handful of highly rated mega-cap technology stocks are skewing index-level valuation metrics. These stocks are expected to grow very strongly over the next few years, capitalize on advances in artificial intelligence. While the fund has positions in specific technology stocks, we are careful to maintain valuation discipline in relation to growth expectations. Global mid and small capitalization companies in general appear attractively priced in relation to their growth prospects. As is our approach, we seek to own the highest quality, most enduring companies across market caps, not simply focusing on large cap equities. Emerging markets appear attractively priced. However, selectivity at country, stock and sector level is critical, especially given the level of strained geopolitical relations and conflicts. Our view is that stock picking quality businesses is set to become increasingly important as technological disruption is set to meaningfully increase on the back of advances in AI. The global economic outlook remains highly uncertain, and the lagged effect of higher interest rates really could start to bite. As such, we seek to invest in companies with appropriate leverage, defendable margins, and resilient growth prospects that also trade at reasonable valuations. Owning a diversified selection of reasonably priced quality businesses across various sectors allows the fund to both take advantage of specific structural and company growth drivers, while also strengthening the fund's ability to weather more challenging economic times.